The extreme valuations of the markets have been unprecedented to say the least. Time and time again, we have watched it break records, defying gravity. The longest bull market in history hasn't been the strongest. 10 years out from the collapse of the financial system, emergency lifelines are still in place. Defibrillators, IV drip, adrenaline, all running non-stop for a decade, and we are now entering in the next phase of the most insane financial experiment in history. Are you ready? You came here for the truth, so let me unveil that for you. Today we're going to talk about what's really going on. I'm going to show you data and statistics that you need to know to understand this financial system. It is absurd. It has gone into a territory we have never been before. And I'm not talking about the prices of stocks. I'm talking about wacky world, okay? Let's get into it right away. If you were watching the markets this week, you know what had happened. Clearly, very bad overall. You can see that this was actually the fifth straight drop on Friday for the S&P 500 and the worst week of the year for the markets just 7 days after the benchmark index hit an all-time high. This happens very frequently. We can see that the market gets a little bit overextended and then it has to come down, except for the fact that this happens to coincide with what we saw with Jerome Powell. They didn't like the fact that he said mid-cycle adjustment. They want further easing. Of course, then we have the tariffs. The tariff issue that is presented right now only seems to be getting worse. The geopolitical tensions are rising between China and the United States. And of course, this will further be exacerbated as time goes on while everything compounds. 70% of shoes sold in the US come from China. With the new tariffs, the industry braces for a hit. We're already seeing the tariffs have an effect. Anywhere you see prices rising, it's going to have an impact on the retailers. The retailers are going to push that onto their consumers, and the consumers are either going to go further into debt, they're going to overextend themselves, or they're simply going to buy less in general. It's not just for shoes, this goes for any product. Traders are betting big on a sudden drop in stocks, and it's starting to pay off. Well, you know the VIX, that thing that continuously heads lower every single day seemingly? It was the best trade of 2017, or should I say the easiest trade. Well, of course, we saw at the beginning of 2018 what happens when everybody shorts the VIX. Well, now people were taking the opposite end of that bet and making some money. Traders have been loading up on call positions in the VIX index, wagering on a big price swing in the market. As soon as Jerome Powell made the speech saying mid-cycle adjustment, the VIX index screamed higher. Now, we know specifically that the Federal Reserve has a short position on the VIX. We know it is manipulated, but here we can see that the fear is underlying all of this. It is very interesting to see what will happen with the VIX in these short periods where you see these bursts, but ultimately they come down so fast with the VIX that it is obviously being forced downward. Personally, I'm really waiting and trying to find how exactly they go about forcing the VIX down and the methods they use, but I haven't found any really solid information on that yet. I will definitely bring it to you when I do. Perfect summer storm brewing for stock correction as the trade issues simmer and more Fed action awaited. Some analysts are expecting a stock market correction in a seasonally weak time of the year, while the market awaits developments on the trade and Fed policy that are not expected until September. So essentially, the market is waiting for this next Fed cut already, even though July just happened. They did cut interest rates 25 basis points, and already they're asking for more. Well, the next meeting in September is a long while away if you are looking at the environment in this market right now. That's not a good thing, and of course, they want this to happen in increased fashion. 25 basis points by then is not enough because they are already expecting 1.5 cuts before the end of the year. I thought this was a really interesting chart and I wanted to put it in here, talk about it a little bit. You can see that a decade of deflation assets massively outperforming inflation assets. The breakdown here is quite interesting when you look at it. Deflation assets being the dark blue line, inflation assets being the yellow line. Take a look at this. By the way, it comes from Bank of America. Inflation assets they define as commodities, real estate, tips, EAFE, US banks, value and cash. Deflation assets on the other hand, government bonds, debt instruments, US investment grade, US high yield, S&P 500, and so on. When you see the breakdown here, clearly the so-called deflation assets have done a lot better in this period, particularly since the financial crisis. Overall, commodities have not done well as they had been leading up into the financial crisis. We saw that spike. 2008 was insane. If you look at some of these different commodities, that was a very big change from what we saw, let's say, over the last 10 years. Not the same environment, that's for sure. When you see the quantitative easing and all of these different market assets that have been inflated by the central banks and their easy monetary policies, things really look distorted and stretched, and there's no other way to put it. This is out of Malden Economics. It is so important to see what he's talking about on this chart. Adjusted for QE and QT, the curve may have inverted in December. If you've been paying attention to this whole scenario that's happening with the yield curve inversion, then this is for you. Look at the light blue line. That's the 10-year, 3-month Treasury yield spread incorporating the shadow Fed funds rate, which we've talked about many times before, and the effects of balance sheet normalization. Look at the change that has actually happened. If you include that, the yield curve inversion is actually quite large, because they say in certain instances where there is a yield curve inversion, but it happens so briefly, happens so quickly that it doesn't necessarily end up in creating a recession. However, if you take these two into account, QE and QT, well then look at where it is today. It is actually well into the negative, a rate that we have not seen for decades and decades, surpassing what happened in the year 2000 as well as 2008. And of course, this is some information you are simply not going to get in the mainstream. That's why I'm bringing it to you here. If you're unaware of what the shadow Fed funds rate is, essentially what we have is the effect of quantitative easing on interest rates, essentially bringing rates down to -3% at their peak. So you can see that this has a dramatic effect on the financial system as a whole, and then they're just basically showing you on this chart how that would look if this was a realistic environment and wasn't so secretive, wasn't so manipulated, and that's why I really love this type of alternative information. Here you can see the Chicago Business Barometer, also known as the Chicago PMI, moving down to 44.4. This is something that is very telling when you look at all of these different PMI ratings, whether you're seeing it in the United States, whether you're seeing that in Europe and China and other places around the world. They have all been contracting from, let's say, 2018 and beyond. And there's something going on here. It's not just a blip. It's not just one little event. And the interesting thing is that this cannot be resolved by central banks. If the central banks bring interest rates down to zero, all of them, Federal Reserve, everybody goes zero or negative, it will not fix this issue. That's what's important to note here. Two manufacturing purchasing manager indexes, you're looking at the PMIs, the market, and the Institute for Supply Management. Both of these have taken a hit recently. They're moving into the negative territory, which shows that there is a contraction, but ultimately you could see that it has come down quite a bit, and it's going right in that territory. There's no denying it. And now what you've come to see, the 10 most insane facts about the financial system right now. The July Fed cut marks the 729th global central bank cut since the Lehman bankruptcy. Soaring U.S. consumer confidence at the highest level versus plunging German business confidence since '98, when the Fed cut rates mid-cycle, igniting the bubble of '99. And it wasn't so good because especially the tech stocks, the Nasdaq, didn't get back to its previous level in 14 years. It took 14 years to get back to that level. Emerging market equities at the lowest level versus U.S. equities since 2003. China weak, U.S. dollar strong. Wall Street now 5.5 times the size of Main Street. Between 1950 and 2000, the norm was 2.5 to 3.5. Wall Street is now too big to fail. Global debt is now 3.2 times the size of global GDP, and guess what? It's an all-time high. Fresh China tariffs in September would raise the average US tariff on total imports to 5.6% from 4.5%. That's the highest since 1972. US companies spent $114 on buybacks for every $100 of capex in the past 2 years. Between 98 and 2017, they spent $60 for every $100 of capex. They are going into astronomical territory with the amount of buybacks that they are doing, much more than they would have done in the previous cycle. Inflows to bond funds, $278 billion worth, rising at a record pace in 2019. Clearly, the funds are changing their positions. There's no doubt about it. Past 10 years, $4.1 trillion into passive investments, $1.5 trillion out of active funds. And we saw that chart, the crisscross that is going to happen in the next few years. More money is flowing into passive, more money is leaving active. Just 6% of the MSCI All-Country World Index stocks account for 53% of the year-to-date global equity return. We are seeing what I call the narrowing band. Essentially, fewer and fewer stocks are making it out, and this is an unfortunate creation of every cycle. This happens because there are less and less winners, let's call them, and then eventually they are the ones that topple the most. This is truly an unfortunate sight that people do not see the patterns and they are not readjusting their portfolios, and unfortunately they're going to be burned. Look at what happened in the year 2000 with technology stocks, which were supposedly going to go up forever and ever. 14 years later, people finally achieved what they had so many years ago. I'm going to end the video there. If you found it informative, then please hit the like button. If you want to support the Money GPS, you can hit the like button. If you want to support the Money GPS in a different way, you can hit the thumbs down button. It's all the same. If you want the financial education you were not taught in school, these two books have everything you need: the foundation, the history, the asset classes, how to make money, so much more. Check the link in the description. If you want the audiobook, that's available at themoneygps.com. If you want to know the detail that simply is not disclosed to you in the mainstream media, then definitely check out this video. I just did it. If you haven't watched it, click on it and I will see you there.